Well, it's a very good question, because when I went to central banks prior to the global financial crisis, this is exactly the question I got asked. You know, we are an independent central bank. What kind of fiscal monetary interactions are you talking about? We have nothing to do with fiscal policy. And it certainly seemed like that to many people, but I think now, following the crisis, most people realize that the borderline between monetary and fiscal policy is kind of not so clear-cut as people had thought. I mean, that there are many different channels that go from one policy to another. What we teach our first-year macro students is the obvious channel where if the government's spending too much and running big deficits, that's going to create, you know, inflationary pressures, and that puts the central bank into a situation where it has to do something. It has to, you know, raise interest rates to ensure that inflation doesn't get out of hand. Obviously, it also affects inflation expectations. There are other channels that are a bit less standard. We have the Sargent and Wallace 1981 unpleasant monetarist arithmetic that basically says that if the government's running a debt, that eventually the central bank might have to might be induced or forced to monetize the debt and just print the money to cover the debt. There's the fiscal theory, the price level by Eric Leeper, that kind of shows a slightly alternative channel through which fiscal policy affects monetary. But in all of those cases, one way or another, the fiscal excesses will spill over to monetary policy and threaten monetary policy outcomes. Well, fiscal policy has been excessive for quite a few decades now, and unfortunately the standard indicators don't always show how excessive it has been, but you really have to look at the full picture. So the problem is the demographics that has been changing quite dramatically. If you look at the 1960s and onwards, when most of the pension systems and healthcare systems were kind of being formed, we had a growing population. We had a population boom, and the number of people that were contributing to the system was growing. And obviously what you should have done is you should have saved all that money and paid them to those people when they retire. However, given the pay-as-you-go system that most countries use to run their fiscal policy, where you take the current tax and pay the current expenditures, this money was not saved. So you can really think of this as a classic Ponzi scheme, as a classic, you know, marketing pyramid, where you had more inflow into the system that wasn't saved. And obviously now we're facing the opposite problem. Now, given the aging population, given the fact that people have fewer kids and they live longer, we now have shortages and less money coming in the system. And unfortunately, you know, we're going to have to deal with it one way or another. And the clear answer is that we need fiscal reforms that actually address these long-term demographic changes. But, you know, they're kind of quite painful politically, and they're very unpopular. So many politicians tend to avoid these kind of solutions. So all the focus in Europe now is on the current debt problems, but it's really just the tip of the iceberg. The big issue is really down the line. It's in the pipeline. It's all that, and I don't see politicians actually paying enough attention to those sorts of things. The paper is really trying to look at two kind of the current economic situation. Think about 2012, 2013. This is the aftermath of the global financial crisis. And the world economy and some leading economies like the US and European countries, the economy is still in a pretty bad shape. The recovery is much slower than we had anticipated, much slower than it was after the previous recessions. This is this short run kind of dimension. What should we do about this, if anything? And then there's the long run perspective that I had just mentioned, which is about sustainability, long-term sustainability of fiscal policy. So what the paper is trying to do, it tries to explicitly model these two perspectives, the short term and the long term, and importantly, it looks at the linkages between them. So how does the long-term fiscal sustainability problem affects the behavior of the policymakers now, whether they should do austerity measures or whether they should do fiscal stimulus. But if they do a fiscal stimulus, that's going to make their long-term situation worse, and it's going to upset the markets. So these sort of issues that the paper is really trying to understand. And obviously the big question is also the monetary policy outcomes. There are these two camps. Basically, the people who focus more on the short term, like Paul Krugman, they're really worried more about the current weaknesses, and they say, well, unless we stimulate the economy either through monetary or fiscal measures, the economy is going to go further down the drain, and it's going to lead to potentially deflationary outcomes and really, kind of big cost on in terms of social welfare. And there's another group, people like John Taylor, they're really more worried about the longer term picture and the fact that inflation may actually increase significantly in the future because of all these various measures we've implemented, like quantitative easing and so on. The Fed's balance sheet has tripled in size since like 2007, or probably more now. So these people are worried, and also given the aging populations and the fact that there's always pressure on the central bank to monetize that, the issue is which of these two perspectives is kind of the more challenging, or the one that we should be focused on, and how they relate to each other. So that's what we're trying to understand in our analysis. In the literature, most papers looking at the interaction between monetary and fiscal policy, they indeed use large-scale kind of DSG models to do that. And we haven't gone down that route for one main reason. The main reason is that we want to capture a slightly different aspect of the interaction between the two policies, which is the strategic aspect. Most of the existing papers can tell us nothing about the strategy, about the game and the political kind of considerations when the central bank is deciding what to do, the governments are deciding what to do, and each institution is trying to kind of put pressure on the other. So, and game theory is a great tool to be able to study these strategic interactions. What one institution does affects what the other one does, and vice versa. And we believe that this is really, in the current environment of the large fiscal gap, of the fiscal hole that's looming down the horizon. I think this is a really important aspect that's been overlooked in the literature. So that's why we use game theory. Problem in terms of the economic uncertainty. Both monetary and fiscal policymakers, they don't know which way the economy is going to go. Is it going to recover okay, or does it need more help in terms of monetary or fiscal stimulus? So that's one complication that we capture in the paper. But the other one is really the conflict between the two policies. Given the size of the fiscal problem, you really have just two possible solutions in the longer term. Either fiscal policy will clean up the mess and carry out a fiscal reform where they align future taxes and expenditures, or the central bank will have to do that by printing money and inflating the debt away, monetizing. That's the unpleasant monetarist arithmetic. So we really set it up as a game between the two institutions. In the literature, it's often been modeled as the game of chicken. And we're really trying to understand under what circumstances which policy kind of wins the game and get the outcomes it wants. So this is in a nutshell what we do in that paper.
So what are the findings? Which policy will have an upper hand?
It depends on several different characteristics, both the structure of the economy and policy preferences. But we identify two important institutional characteristics that matter. And we actually use a novel game theoretic approach where we generalize the timing of the game. So we allow for stochastic revisions of the policy actions. And through that channel we are able to explicitly model a feature that we call long-term monetary commitment. And we find that this is a really important tool that allows the central bank, if the central bank is committed, and you can think of that commitment as for example, legislated inflation target like 2% inflation, that really helps the central bank to kind of protect itself against the fiscal pressure, because they can always say, look guys, we're not having any of that spending, we need to raise interest rates to offset that pressure. We have that target that is legislated, this is our mandate, and we have to pursue it. And that really, if the central bank is strongly committed, and some are and some aren't, the Fed, for example, the Federal Reserve in the United States does not have a legislated numerical inflation target. But if a country does, it really seems to help the central bank to kind of fight the fiscal pressures and give the central bank ammunition to fight the government. And what does that do? Well, that actually changes the incentives of the government to run the debt in the first place. If the government knows that whenever they come up with a package and try to buy more votes by extending all the whatever spending they pursue, then if they know that the central bank is going to try to offset that by raising interest rates, and they're not going to get the political benefits that the government hopes for, the government has less of an incentive to actually do that. So one of the interesting kind of implications of our analysis is that if you have a strong monetary commitment, it may actually discipline fiscal policy in some sense. That fiscal policy, stops running deficits and kind of moves towards more of a balanced setting. Obviously, if that's not the case, then it's likely that the fiscal policy is going to have the upper hand and kind of induce the central bank to deal with the fiscal problem by monetizing it. No, it doesn't mean that. There are two types of central bank independence that the literature talks about. In fact, I think the distinction goes back to Fisher and DeBell. There's a goal independence where the central bank can just decide whatever their objective should be. And then there's instrument independence or operational independence, which just means that, given the objective, they have the freedom to set interest rates in order to be able to achieve that objective. And there's a big debate, which one's the better one, but I think there's more or less a consensus that central banks need to have the latter one, the instrument independence, but they don't need the goal independence. In fact, they should not have goal independence. Why? Because think about it, would not be democratic. Think about an independent institution that doesn't have a political mandate. The governor wasn't voted by the voters, but it could decide on such important matters as what to do. So that is not something we would want. So it is that the society or the government imposes the inflation objective or some kind of goals on the central bank, and then the central bank has an independence in terms of how to achieve those objectives. And obviously with that independence comes accountability. So the central bank is accountable for achieving those objectives. That's true. Goal independence seems to imply instrument independence, but not the other way around. So goal independence is kind of more of an independence than just instrument. And what I'm trying to suggest that we should kind of limit that only to the instrument independence. In New Zealand, for example, there's what they call policy target agreements with the two institutions, the governor, the central bank, and the government. Whenever there's a new government that comes into power, they sit down and they sign this target agreement, and they basically agree on what the target should be. That seems like a good option. In fact, Don Brash actually argues that it also has a big disciplining effect on the government when the government is forced to agree with the central bank on what the target should be. Because once they agree, then the government cannot really come up and run up these huge deficits that are inflationary, because the central bank can always say, look, you agreed with me on this target, but your policies are really causing me to struggle with that target. So you have to change your policies. And given it's all transparent, it's all legislated, the public can see that the central bank is right. And again, that puts pressure on the government to behave on the fiscal front. So that is, and there's other examples that you can think of. The Bank of England has a different accountability procedure. They have this open letter. So the governor has to write this open letter to the Chancellor of the Exchequer if inflation deviates, by I think 1% above or below the target. And again, in that letter, they have to explain clearly, why it deviated and what measures are going to be implemented for inflation to come back to the target range. So there's a lot more transparency and accountability in monetary policy making that there used to be. And the important or interesting point is that we don't see any of that on the fiscal front. Or that there are some exceptions, but most countries do not have any transparency in fiscal policy. And as Eric Leeper argues, this fails to anchor fiscal expectations and leads to really undesirable outcomes. This is a common misperception. This is, in fact, and even former Fed Chairman Greenspan, I think, had this misperception. The idea that the explicit inflation target actually implies a strict inflation target. That is not true. All the inflation targets in developed countries the commitment is not to 2% inflation, every period. That's a commitment over the medium run, over the business cycle. So that's on average. On average, you have to be at that level, on that narrow range. But it actually allows for deviations over the business cycle. And because it allows for deviations over the business cycle, that allows the central bank to actually stabilize the real economy and look at, unemployment and so on in attempt to reduce the volatility of these real variables. So, and there's a lot of empirical research that shows that even countries like New Zealand with what's called a unitary mandate that has price stability as the only monetary policy objective, they actually respond in the very same way as the United States, where they're still trying to stabilize the deviations. The recent crisis is a good example because, as you saw, most central banks have really deviated from their inflation targets in order to support the real economy. And it didn't matter whether they had a dual mandate like the Fed, or whether they had a unitary mandate like the Reserve Bank of New Zealand. So no, it does not mean when I'm advocating a monetary commitment, what I'm advocating is really one that is legislated, but it's an average commitment over the long run. It does not mean that the central bank really has to be very strict and basically ignore the real economy. That's not what. And in fact, I have a paper that models this explicitly and shows that explicit and strict inflation targeting is something very different. And if you have an explicit target, it doesn't have to be strict at all. It is true, and one of the prime examples of Joe Stiglitz, who've been critical of inflation targeting for a long time. In fact, recently Jeff Frankel said that inflation targeting, in his view, passed away in September 2008. I disagree. I certainly agree that we might need to make changes to the way inflation targeting has been run. Clearly, one of the things that was highlighted by the crisis is that the framework might need to look more explicitly at other asset prices, like housing or maybe another monetary aggregate. So the two-pillar strategy that the Bundesbank used to have and that people criticized seem to have been kind of a good thing, or a way to really take on board more things like money or asset prices. In fact, in new Keynesian models that were very popular prior to the crisis, there's no room for money at all. That variable doesn't even feature in that analysis. So I think we do need to look at other things. Whether, how we do that, whether we extend the inflation target so that it no longer looks at just consumer prices, which is the case in most countries, but really has a broader measure of inflation, that remains to be decided, and I think a lot more research is needed for that. There are pros and cons. One of the obvious disadvantages that you're going to lose a little bit of that anchoring effect, because if you have a broader measure, people understand what CPI inflation is. If you have a broader measure, it might be harder to understand, and inflation expectations are not going to be as well anchored, which is going to cause some problems for policy. But on the other hand, there's going to be some advantages in terms of more, focusing on the right thing. So I'm not saying that we don't need changes to the inflation targeting framework, but I'm still yet to see any major problems. The Fed has not really been an explicit inflation targeter, and they've had probably the biggest problems. So I'm really, and as we've seen, the central banks have really kind of focused on the weaknesses in the economy. So they have not blindly pursued their inflation objective. So look, it'll be interesting to see which way it goes. But as I mentioned, there are some good advantages of inflation targeting, and the robustness of the regime seems to be evidenced by the fact that, in fact, no country, to my knowledge, has ever abandoned the regime. And in fact, I have another paper that tries to model the advantages, not only the anchoring, but also things like a reduction in the monitoring cost to the public. I mean, in the past, you had a lot of people in commercial banks trying to just understand all this mystique that was coming out of the Fed and trying to understand which way the Fed was moving. They wouldn't even tell you what they did with the interest rate. Now most central banks don't only tell you what they're doing with interest rate, but they tell you everything else. They publish their models, their forecast, all those kind of things. And that seems to have really contributed to better understanding of monetary policy and the transmission mechanism of by the private sector, which I think is, for the private sector, it's certainly a good thing. It's just cheaper for them to take all the information rather than having to spend days and days trying to work them out. So we'll see. We try to do something. We have a recent Czech National Bank working paper with Michal Franta, who in fact is a graduate of this institution, CERGE-EI, and Petr Stehlik, who's in Pilsen. We try to track monetary and fiscal interactions over time and across countries. So what we do, we set up, we use this novel empirical technique, time-varying parameter vars, combined with sign restrictions, and we basically try to understand how monetary policy responds to fiscal actions. So we look at one of the things we do, we look at the impulse responses of the central bank, so the changes in the interest rate, to a debt finance fiscal shock. So think of a situation, it's before the election, it's not that you are in a recession or something, so there's no real need for spending, but the government nevertheless wants to appeal to the voters, and it comes up with a fiscal package. How will the central bank respond? Under the ideal circumstances, what you would like to see is the central bank actually to offset the inflationary effects of that fiscal stimulus. The central bank should increase interest rates, basically go against the government, fight with the government. That's the game of chicken. Sometimes it's also, think of this as a tug of war. And the question is, will the central bank do that, or have central banks done that? So we look at three main inflation targeters, or three early inflation targeters: Australia, Sweden, and Canada. And we look at three non-targeters: the US, Switzerland, and Japan. And what you see, the evidence is not 100% clear-cut, but generally what you see that over in the inflation targeting countries, in the early 80s and so on, the central banks accommodated. So lowered interest rates, did the wrong thing, and basically said, there you go, Prime Minister, we're not going to cause any troubles. You want to spend, you run up debt, we're going to lower rates so that you can finance the debt easily. And over time, especially after the implementation of inflation targeting, central banks no longer do that. In fact, central banks seem to do the right thing and go against the government and raise interest rates in inflation targeting countries. So there was a clear change. If you look at the non-targeters, like the US, you see the exact opposite. Chairman Volcker was fighting, in the early Reagan times, the big deficits. But from then on, you see monetary policy accommodation of fiscal shocks. So you see lowering rates, and you see that both on impact, so the immediate, as well as over a longer horizon. So that's an indirect, a very indirect, I have to say. It's not a conclusive evidence, but it's indirect evidence of the fact that inflation targeting, so an improvement in monetary commitment, may have actually had a disciplining effect on fiscal policy. And even if you just plot, which we do in that paper, if you just plot fiscal balances, whether you run a deficit or a surplus, you'll see a clear change about 2-3 years after implementation of inflation targeting in all those countries, including UK and so on. You see going from deficits to surpluses, and basically, having a good fiscal policy all the way to the crisis. In the non-targeters, you don't see that, you see the opposite. Now, one thing I should say is that I've been talking about the deficit, but there's actually a lot of literature, for example, Larry Kotlikov, that rightly argues that the deficit is a statistic we should really not pay much attention to. It only shows you it's a very kind of inaccurate and simplistic view of the whole debt, primarily because it's not taking into account all the future liabilities that the governments have. So it just labels something as official debt, but the fact that someone has paid all his life pension contributions, and the government owes him now his pension, the promised pension, this is not captured by the official debt. And if you actually calculate the size of that debt, the size of this fiscal gap, that's actually multiples bigger in most countries than the official debt. For example, in the United States, the official debt is something over 16 trillion US dollars. The unofficial debt, if you take the net present value of all the future expenditures minus all the future liabilities, you get to a number that's something in the order of 230 trillion. So more than 10 times more than the official debt. And again, that's so we really need to talk about this number rather than the official deficit and debt, because these are meaningless statistics. But you know, I use them because everyone else is using them, so that we have a common language. Well, the analysis precisely shows that this is the wrong way to ask. You know, it's not that we need austerity or that we need a fiscal stimulus. We can actually have both. What we need, given the fiscal problems are long term in most countries, not Greece, but in most countries, it's really the longer term problem. We do need austerity in the sense, we don't need austerity now, but what we need a long-term fiscal reform. You need to move away from, you know, pay-as-you-go pension systems, for example, and you need really, you need to reform healthcare. Healthcare is actually even bigger problem than pensions. If you look at healthcare, per capita healthcare, it's just been booming, and no one seems to have good answers on how to stop that. But anyway, so what you need is to do these big long-term reforms. And once you've done that, you can actually look at the short-term weaknesses in the economy and have a short-term stimulus now. Okay. Instead, what European countries are doing, they're doing the exact opposite. They're not solving the long-run problems, and they're implementing short-term austerity. And what it does is that it's killing growth, and it's making the debt problems worse, because one of the key determinant of the debt to GDP ratio is actually the GDP. And if you're in a recession, then even if you run a bit of a surplus, if your debt to GDP may actually be growing. So we don't need, you know, you may still have a fiscal stimulus and a long-term fiscal reform, and you don't need austerity now. The timing of austerity is really important, and it's, you know, if you look at, I here agree with Paul Krugman that this is really, if you look at the last 3 years, you see a clear negative correlation between, you know, the degree of austerity implemented and growth. So the countries that have had most austerity in Europe have had some really bad economic outcomes. Well, monetary union is we show basically that all the things I mentioned about monetary commitment goes through in a monetary union. But there are two main problems on top of that, which means that the situation is worse in a monetary union. One is, and that's known, and in fact Paul Krugman is again someone who's been talking a lot about this, is that the EMU is not an optimal currency area as it is. And that means that it may actually hurt most of the countries. We saw that clearly before the crisis. If you look at the early mid-2000s, France and Germany were not doing too well, they were stagnating, whereas Spain and Ireland were booming. And if they were not in the European Union, the European Monetary Union, well, you would see a cut in the interest rate in Germany and France, and you'd see an increase in interest rates in Spain and Ireland. But obviously, because they have a common currency, you couldn't do that. So, in fact, the interest rates wouldn't change much, which meant that they were too high for Germany and too low for Spain and Ireland. And in the latter two countries and others, it actually have very much fueled the housing bubble in those countries. You know, low interest rates mean there's a lot of housing construction, a lot of people taking mortgages and so on. So you could, you know, these countries could rightly argue that, you know, euro did a lot of damage in those countries. They're very different from the Greek story where you have, like, you know, fiscal waste. That's different. And the interesting thing is that now you need the opposite. Germany, through that period before the crisis, they've got a lot of competitiveness because inflation in Spain, you know, Southern Europe was much higher, meaning that the German unit labor costs have dropped, say, 25% relative to the south of Europe. So no wonder that Germany is now benefiting from that by having, you know, by being the only country that's growing in Europe, or one of the few, and having huge exports and growing exports. And what is basically what the solution being suggested, because the ECB is not it doesn't want to hear about higher inflation, that means that for this competitiveness to be reversed, you'd actually have to have an internal devaluation in Spain and others, which basically means, you know, having deflation. And we know that that's a bad thing with very negative economic consequences. But so that's just an example of how the EMU might be hurting. But that's the standard story. We identify a different story. That's what we call a free riding. And it's different free riding from just, you know, a small country relying on a bailout by a big country. What we show is that in a monetary union, think of a small country entering the EMU. And think about the story what we had before where monetary policy can discipline fiscal policy. But now, within a monetary union, if a country like Greece is spending too much on the fiscal front, you know, the Bank of Greece can't discipline them now because the interest rates are out of their hands. And what is the ECB going to do? Well, the ECB has to again look at the union as a whole. And because Greece is just a small part, the ECB is not going to do much. In fact, that's precisely what was happening in the early 2000s. So you lose that disciplining channel that you had. And we show in the paper that makes it, you know, all the worse. And obviously you lose another disciplining channel, that's the financial markets, because we saw in the early 2000s that the risk premium between, you know, Greek and German bonds kind of converged. So financial markets interpreted it as Greece being implicitly insured by the big countries, and you know, they were right. So there seem to be a number of problems, and I want to say I'm not a Eurosceptic by any means. I mean, you know, I think a monetary union can work under some circumstances. I think few people would argue that the US would be better off if they had individual currencies. But you know, it becomes increasingly clear that the euro, as it is, it's just too broad. And it may be doing some damage to some countries. Well, I think it's there's academic research that shows that one of the things that would be desirable is if the European Central Bank allowed for temporarily higher inflation. There's a paper by Uribe and Schmidt-Grohe who suggests something in the order of you know, inflation of say 4% for 5 years. You know, there are risks associated with this, and generally I'm not someone who embraces higher inflation, but this would certainly help to overcome that problem of competitiveness, because you wouldn't have to have wages and prices in Ireland, Spain, and those kind of periphery countries to actually fall into the deflation territory. All you'll have is that, you know, if they stay put, that inflation could still erode some of that, so that would reduce the real wage. And I think the implication is that probably, and I've been saying that ever since the cheating of the Greek deficit numbers became apparent in, I think, late 2009, that Greece will kind of go bust and will probably have to leave the euro. I mean, no one really has a good scenario how that would happen. That's why no one wants to even contemplate that. But I just can't see how that might continue. I'm afraid not. The problem is I talked about the long-run drivers, the long-run problems, and they're really aging populations combined with the pay-as-you-go system. The Fiscal Compact is not talking at all about those things. In fact, it imposes a straitjacket of a balanced budget. And by the way, it talks about balanced budgets, and then in the next sentence it actually allows a deficit of 0.5. So somehow in the European mathematics, it seems to be the case that, you know, minus 0.5 is actually greater or equal than 0. But anyway, leaving that aside, what that straitjacket does is that if you have an aging population and your fiscal problem is getting worse, if you are to achieve balanced budget, it means that every year you have to perform more and more arbitrary short-run cuts into, you know, important infrastructure projects or education and so on, because, you know, every year you have fewer people working and more people receiving, you know, pensions and healthcare. So you just have to come up with arbitrary cuts, and that's really, you know, you just need a solution that's just going to be long term, so that it doesn't hurt particular groups in the society excessively, and this is not happening. So that's you know, the attempt is correct to do something about it, but I think it may actually be counterproductive. Well, that's a similar problem. Fiscal union is only going to sweep the problems under the carpet. I think it may be a way to, you know, calm down German voters, because they're not gonna, now they complain they're paying for the Greeks, and, you know, somehow once it's a fiscal union, then, you know, these transfers are not so visible. But, you know, the only thing it's going to do, it's not going to solve the real problems, it's just going to make them worse. Think about Italy, okay? Think about the North and the South. They're in the monetary union, and they have a lot of transfers from the North to the South. And what you're just going to be doing is that you're not going to be addressing the situation and trying to bring these different regions together economically. You're just going to kind of conserve those differences and just turn a blind eye over them. So again, I'm not saying, and you know, I think politically it would be very hard. You know, those countries are quite unique. But even if it was possible, I'd prefer to see a fiscal reform. And, you know, per se, I'm not an enemy of a fiscal union. If this is where we're going, if Europe's going to become one nation, that's possible. But again, it shouldn't be a way to deal with the problems, because it would just try to you know, avoid them rather than solve them.